Hey everyone, and welcome. When you're looking for a home loan, you might think a mortgage is just a mortgage. But is that really true? Today, we're going to pull back the curtain on a very special category called high priced mortgage loans. They come with their own unique set of rules, and trust me, knowing what they are is absolutely key to protecting yourself as a homebuyer.
So let's just get right to it. Are all mortgages created equal? The short answer? No way, not even close. Some loans, simply because their interest rates are a bit higher, actually unlock an extra layer of protection. Think of it like a built-in safety net, designed specifically for you, the borrower.
All right, so why the extra rules? It's not just random red tape. These regulations were basically forged in the fire of the housing crisis. They were designed for one big reason: to stop the kind of risky, predatory lending that caused so much trouble for so many people. Yeah, after that massive crash in 2008, a whole bunch of new laws popped up, things like the SAFE Act and the Dodd-Frank Act. And their main goal, their whole reason for being, was to put a stop to dangerous lending. The rules for high-priced mortgage loans, they're a direct result of that push, creating real, solid protections for consumers. And you can see, this whole idea of protecting consumers isn't exactly new. It actually goes all the way back to the 60s. But look at that flurry of activity right after 2008. That's when things really kicked into high gear. It was a huge, concentrated effort to make the entire mortgage system safer for everyday people. Okay, now let's clear up some of the lingo, because this is super important. In the world of mortgages, the words priced and cost sound almost identical, right? But believe me, they mean very different things, and they trigger completely different sets of rules and protections. This breaks it down perfectly. On one hand, you have high-priced loans. That's our focus today. Their rates are moderately higher, and the big protection you get is a mandatory escrow account. But then you have high-cost loans, and that's a whole other level. We're talking way higher rates or fees, and they trigger even stricter rules, like having to get counseling before you can even sign the papers. So what's the tripwire here? What's that invisible line that a regular mortgage crosses to officially become a high-priced mortgage loan, or HPML, and get all those special protections we've been talking about? Well, it all boils down to this thing called the average prime offer rate, or APOR for short. The easiest way to think about it is this: it's the average interest rate that lenders are offering to borrowers with the best credit on any given day. It's the official yardstick that we measure every other loan against. And here's exactly how that yardstick works. For a standard run-of-the-mill first mortgage, if its annual percentage rate, the APR, is 1.5 percentage points or more above that day's APOR, bam, it's officially an HPML. So if the APR is, say, 6%, any loan with an APR of 7.5% or higher gets that special label and all the protections that come with it. But it's not a one-size-fits-all rule. The trigger point actually changes depending on the kind of loan you're getting. For those really big jumbo loans, the buffer is bigger. It's 2.5% over APOR. And for a second mortgage, it's even higher, at 3.5%. It's all about adjusting the rules for different levels of risk. So, what happens if you find out your loan is an HPML? The first thing to know is don't panic. It's not a penalty. It's not a bad thing at all. In fact, it actually means you are legally entitled to a powerful set of extra protections. And these protections are a huge deal. You get 3 main safeguards. First, a mandatory escrow account for your taxes and insurance. Second, you're not allowed to be charged any penalties for paying off your loan early. And third, a very special 2 appraisal rule kicks in to make sure you're not getting a bad deal on the house. Now, let's talk more about that escrow account, because it is so important. The law says that account has to stay in place for a minimum of 5 years. That gives you this long-term stability, this buffer against any sudden, nasty surprises with your property tax or insurance bills that could totally wreck your budget. And even after those 5 years are up, you can't just cancel it whenever you want. There are conditions. You have to have paid your loan down so that you owe less than 80% of what the home was originally worth, and you have to be completely current on your payments. It's all about making sure you're standing on solid financial ground before you take on that responsibility yourself. Okay, now for what I think is one of the most interesting protections, the 2 appraisal rule. This was specifically designed to put a stop to a pretty shady practice called property flipping. Where someone buys a house on the cheap and then tries to sell it again almost immediately for a huge and often totally inflated profit. Here's the scenario. Let's say a seller buys a property. Then, sometime in the next 3 to 6 months, they try to sell it to you, but they've jacked up the price by 20% or more. If you're getting an HPML, that's a huge red flag. Your lender is now required by law to get a second, totally independent appraisal to make sure that new price is legitimate. It's a built-in reality check.
And here's the best part of this whole deal. You, the home buyer, don't pay a single penny for this extra layer of protection. The lender is required to cover the cost of that second appraisal. It's basically free peace of mind, written right into the law for you.
So, when you put this all together, what's the big takeaway? What's the grand idea behind these high-priced mortgage loan rules? Are they actually working?
Well, in a nutshell, these rules, known as Section 35 rules, create this critical safety net for a very specific slice of the mortgage market. They provide guardrails. You get that escrow account for payment stability, you get to pay your loan off early without a penalty, and you get that extra appraisal to make sure you're getting a fair deal. It really is about making the market safer for everybody.
But, of course, this leads us to the million-dollar question. Do these rules actually create a safer market for everyone? Or, by adding these requirements, do they end up limiting access to credit and making it harder for some people to get a loan in the first place? It's that tricky balancing act at the very heart of financial regulation. And there really is no easy answer. Thanks so much for joining us.